There are two common challenges that traders often encounter with liquidity. The first is identifying which level is truly being targeted, and the second is determining if price action will lead to a continuation or a reversal. This requires a solid grasp of advanced market structure, something many traders are missing. So in this video, we've simplified everything essential about trading liquidity into 5 easy-to-follow steps. So if that's something you're into, make sure to hit the like button to support more content like this and subscribe if you're new here. Catch you right after intro. So let's not waste any time and jump right into step 1, recognizing the various types of liquidity. Liquidity points to zones on the chart that either hold a significant number of pending orders or clusters of stop losses, and it appears in two distinct types. When most people mention liquidity, they're generally talking about external range liquidity, ERL, which refers to either a previous swing high or a previous swing low. These zones are key areas on the chart, as they typically lead to either a continuation of the current trend or a reversal, often through liquidity runs or liquidity sweeps, both of which we'll break down later in the video. The second type is internal range liquidity, IRL, which is essentially another term for fair value gaps, FVGs. Price movement relies on these gaps as energy to target those swing highs and lows. It's crucial to observe how price reacts to both liquidity types. Together, they give you clear signals about the market's next directional move. For our next step, we're going to cover order flow, and how it guides us in identifying the correct liquidity level to focus on. When analyzing a chart, the first thing we should do is determine whether the current order flow is bullish or bearish. This is based on whether price is moving through buy-side or sell-side liquidity. At first glance, this can seem a bit overwhelming, but it becomes clearer when we apply two key ideas: break of structure, BOS, and change of character, CHOCH. Let's break these down. When a new swing is established on the chart, liquidity zones form at both the swing high and the swing low. The high marks the buy-side liquidity, while the low represents the sell-side liquidity. For understanding break of structure and change of character, we observe which liquidity side was breached as the new swing formed. In this scenario, it's the buy-side liquidity, which suggests the market is currently following a bullish order flow. With that in mind, the present break of structure point is located at the buy-side liquidity. This is because a break of structure shows us the level that must be breached for the existing trend, here, an uptrend, to remain intact. Conversely, the current change of character point would be found at the sell-side liquidity. That's because if price hits this lower point, it could imply that the order flow is shifting, in this case, transitioning from bullish to bearish. However, in this example, price climbs above the buy-side liquidity, triggering a break of structure and confirming the continuation of the uptrend. And with this fresh bullish swing, we now have a new set of break of structure and change of character levels to use in evaluating the trend's ongoing strength. Here we see another example of a price swing, but in this case, when we examine the liquidity that was taken out before the swing formed, we notice it was the sell-side liquidity, indicating that this chart is currently in a bearish order flow. This means that the active break of structure level would now be the sell-side liquidity zone, as this is the level sellers would aim for if the downward move is to persist. On the flip side, the change of character point would be found at the buy-side liquidity, because hitting that area could suggest a shift in order flow, from bearish to bullish. But in this scenario, price pushes lower, breaking through the sell-side liquidity, confirming a break of structure and signaling that the downtrend is continuing. To summarize, a break of structure, BOS, happens when a liquidity level is breached in a way that validates the ongoing market trend. And one of the core principles in trading is that we should always align our trades with the market's order flow, never going against it. But that leads us to an important question: how can we recognize when the order flow has actually reversed? Now, we're looking at another example of an uptrend, which is confirmed by a break of structure. Assume that price has now encountered resistance at this point. But this time, instead of forming a new higher low, we observe price pushing down to create a lower low. This marks what we refer to as a change of character, the first clue that market sentiment might be shifting from bullish to bearish. Once this happens, that new lower low now becomes our break of structure point, while the prior swing high transforms into the change of character level. That's because the swing high would now need to be broken in order to signal that bullish order flow could be returning, However, at this stage, we shouldn't switch to a bearish bias just yet, and here's why. This apparent change of character might simply be a liquidity sweep. Instead, we need to wait and see whether price continues lower, breaking through the new break of structure level, which would confirm that a downtrend has begun. To wrap up, a break of structure, BOSS, is used to confirm continuation of the trend, while a change of character suggests the order flow may be heading in the opposite direction. We're now going to build on everything we've discussed so far with the next step, understanding how external range liquidity, ERL, and internal range liquidity, IRL, relate to each other. In this scenario, we're observing an uptrend, which is confirmed by a break of structure as price pushes above the previous swing high. With this fresh bullish swing in place, we now identify the current external range liquidity, ERL, points. Since we recognize that the market is in an uptrend, our expectation is for price to aim toward the upper buy-side liquidity zone. But to achieve that, it first needs to locate a level of support, something that can launch the next upward movement. This is where we examine the earlier swing for bullish internal range liquidity, IRL, which typically shows up as a bullish fair value gap, FVG. That IRL zone acts as the fuel the market uses to break through the buy-side external range liquidity, ERL. So what we've just witnessed is the market tapping into internal range liquidity, IRL, in order to drive price through the external range liquidity, ERL. This movement results in a new swing being formed, and with that, a new set of external range liquidity levels comes into play. If we anticipate that the uptrend will persist, we again need to look inside this latest swing for a bullish fair value gap, FVG, which could power the next bullish impulse. To recap this concept, when the market is in an uptrend, we generally expect each impulsive leg to leave behind internal range liquidity, IRL, appearing as bullish fair value gaps, FVGs, which the market can later utilize to drive price beyond the buy-side external range liquidity and produce new higher highs. In a downtrend, the logic is exactly the same, just flipped. If we anticipate that price will break through the sell-side external range liquidity, ERL, we need to search the prior bearish impulsive move for internal range liquidity, IRL, in the form of bearish fair value gaps, FVGs, that can propel price downward. This dynamic highlights how internal and external range liquidity work together to shape trending movement in the market. Keeping this in mind is essential while conducting technical analysis. Because when internal range liquidity zones begin to fail or get ignored, it's often the first clue that price may be aiming for the change of character level, potentially signaling a complete reversal. Let's move into the next key concept, understanding the difference between a liquidity run and a liquidity sweep, and more importantly, how to anticipate which one is likely to occur. When price approaches an external range liquidity level, whether it's a previous high or low, it generally reacts in one of two ways. The first scenario is that price continues in the same direction after clearing the liquidity level. This is referred to as a liquidity run. The second scenario is when price hits that level and then sharply reverses. This is what we call a liquidity sweep. While the idea sounds straightforward, being able to correctly predict how price will behave at these liquidity points is something many traders find difficult. So let's begin by taking a closer look at liquidity runs. Let's take a look at a scenario where price is approaching a swing high. This is our current external range liquidity target. Price pushes up and breaks above this level with a candle close. But this alone doesn't confirm a liquidity run, it simply indicates a breakout for now. To confirm that the market is likely to continue upward, we want to see another bullish candle form after the breakout that creates a fair value gap, FVG, ideally one that overlaps or aligns with the breakout zone. Why? Because this creates internal range liquidity, which price can later revisit and use as support during a retracement, a key element for sustaining the bullish move. Now, it's worth noting that if the FVG forms just above the liquidity level, that's also valid. What matters is that this bullish FVG is formed during or immediately after the breakout, not before it. If the fair value gap appears prior to the breakout, it doesn't validate the liquidity run. It may already be mitigated or irrelevant to the current move. So, we wait for the market to confirm the continuation by forming proper internal range liquidity after the breakout. And of course, when it comes to sell-side liquidity runs, we simply apply the same logic, just flipped for bearish price action. Now let's break down liquidity sweeps. Picture a swing high acting as our current external range liquidity target. As price approaches and taps into this level, it fails to close above, signaling weakness from buyers. This failed breakout is what's commonly referred to as a fake out, but more specifically, it marks the beginning of a liquidity sweep. At this point, we start anticipating a reversal in order flow, which means our focus should now shift toward identifying potential short opportunities. But here's where it gets interesting. Even if a bullish candle does manage to close above the liquidity level, that doesn't completely rule out a liquidity sweep. We need to observe where the last bullish fair value gap, FVG, was formed. If that FVG sits below the liquidity level and price pulls back to it and fails to respect it, this signals potential weakness in bullish momentum, an early clue that order flow could be shifting. Still, this isn't the moment to blindly jump into a trade. From here, we refer back to the market structure principles we covered earlier. We want to see price push below the previous swing low. This would trigger a change of character, CHO-CH, offering a stronger indication of a possible trend reversal. The final confirmation we're watching for is whether the resulting bearish leg creates a bearish fair value gap, FVG. If it does, this newly formed imbalance can act as a resistance zone, giving sellers a valid point to continue driving price downward. Once we see a break of structure, BOSS, following this move, it confirms that the market has transitioned into bearish order flow. This entire sequence is a typical footprint of a liquidity sweep. And the key takeaway here: never base your trades solely on price reacting to a liquidity level. Instead, let the market structure unfold, wait for confirmation through fair value gaps and structural breaks, and only then look to enter with a clear directional bias. Now let's move on to the next crucial step: using top-down analysis when identifying high-probability trade setups. We'll walk through this using a specific segment on the 4-hour time frame. First, we need to determine the direction of the current order flow. In this case, it's clearly bullish, confirmed by a break of structure, BOSS, above the previous buy-side liquidity level. This tells us that we should now be looking for buying opportunities within the current price range. But the big question is, where exactly do we look for an entry? Recalling what we discussed earlier, the relationship between external range liquidity and internal range liquidity, our eyes should be on a fair value gap, FVG, that formed within this bullish leg. That FVG gives us a potential zone for a long entry. However, here's the key: don't just blindly enter the moment price taps into that FVG. Instead, apply the top-down strategy. Zoom into a lower time frame, like the 15 minutes or 5 minutes, and analyze how price reacts inside the 4H fair value gap. We're looking for signs that the market respects the FVG, ideally through a shift in structure or creation of new internal range liquidity that aligns with a continuation in bullish order flow. This multi-timeframe confirmation significantly boosts the validity of the trade and filters out potential fake outs. Now we're looking at the same chart, but this time on the 15-minute time frame. As expected, the current order flow on this lower time frame is bearish, confirmed by a clear break of structure. However, keep in mind that we're aiming to enter a long trade, so what we need to see is a bullish reversal on this 15-minute chart, one that aligns with the bullish order flow on the 4-hour time frame. To spot this reversal, we first identify the external range liquidity levels, and right away, we notice a liquidity sweep take place. As we've learned, this is the first sign of a potential reversal. Next, we see the existing bearish fair value gap, FVG, get disrespected, followed by a change of character, CHO-CH, both of which signal that bearish momentum is weakening. At this point, we're just waiting for the final confirmation, a bullish break of structure. And once that happens, the reversal is confirmed. Now here's where it gets exciting. The first fair value gap formed after this reversal is commonly referred to as the silver bullet. Why? Because it's considered the highest probability FVG for entering the new trend direction. So in this case, that silver bullet FVG is exactly what we'll use to enter our long position, fully aligned with the bullish 4H order flow and supported by a confirmed reversal on the 15-minute chart. Now, switching back to the 4-hour time frame, we can confidently confirm that the 4H fair value gap, FVG, has been respected, thanks to the 15-minute trend reversal we previously identified. At this stage, our focus is on seeing the price continue its move upward toward the buy-side liquidity, which serves as a solid target for exiting the trade. Of course, there's the option to hold the position longer, especially if we anticipate that the bullish trend will continue. However, doing so requires a shift to a higher time frame to assess the broader market structure. Once we move up to the weekly time frame, we notice that the market is forming strong bearish swings. So while our long trade setup made perfect sense on the 4-hour chart, we can now see that price is approaching a bearish weekly FVG, indicating the potential for a reversal in line with the higher timeframe structure. The key takeaway here is this: always begin your analysis on the highest timeframes available. This provides crucial context and helps you anticipate how the market is likely to react when it reaches key liquidity zones on the lower timeframes. That wraps it up, traders. Thanks for watching. I hope you gained real value from today's breakdown. If you did, smash that like button. It genuinely helps the channel grow and reach more traders like you. And if this is your first time here, consider subscribing so you stay in the loop with all our upcoming content and trading insights. Thanks for tuning in, and as always, stay sharp, stay disciplined, and I'll catch you in the next episode.